What if I told you your favorite ski resort might not be as safe as you think? Not because of snow, not because of crowds, but because of something far more dangerous: the balance sheet.
There's a chart out there that almost no one is talking about. It suggests that Vail Resorts could be heading into some serious trouble.
And if you ski at Vail, Breckenridge, Park City, Whistler, it matters more than you think. Stocks don't move for the reasons you're told.
The real story is buried in the data and what nobody's saying.
We're digging it up.
I'm Professor Joel Litman, a forensic analyst and Altimetry's co-founder and chief investment officer.
And I'm Rob Spivey, Altimetry's co-founder and director of research. This is the Altimetry Authority. Let's zoom out. Vail Resorts, ticker MTN. It, by the way, is not just Vail. It's an empire. There are dozens of resorts across North America and beyond. You've got Vail, you've got Breckenridge, you've got Park City, Heavenly, North Star, Whistler, Blackcomb, Stowe, Okemo, Hunter, Andermatt in Europe. You've got a bunch of Australian mountains. These are some of the most iconic destinations in skiing. And for years, it was viewed as one of the best business models in the world, and certainly in experiential leisure. But recently, Vail cut its guidance. And just the headline, what happened, it was not pretty. You had a company that the market was expecting $230 to $240 million of earnings for 2026 that now is forecasting between $140 and $190 million. The company is so desperate because nobody is showing up to its mountains because of how bad the snow is that they have promised for 26 and 2027 ski season, they are going to cut Epic passes by 20% to try to lure people in. Look, less snow means fewer visitors. Fewer visitors means less revenue. And that is stacked up for the company. Just literally in the last few months, the stock is down over 20% while the market continues to make new all-time highs. But here's the point. This whole entire story about this quarter and this year causing the stock into a tailspin is actually coding over a way bigger issue that has been building up over years. Because it is not just one bad month, one bad winter. This is a way bigger story and is an easy explanation of that deeper story. In 2008, Vail was looking around and saying, wow, we need to rethink what we're doing as a business. And the biggest issue that they were having was their whole entire business model was uncertain based on how the snow was, right? If the snow was bad, nobody was going to go to your mountain. You were entirely dependent as to whether or not you had a good snow year or a bad snow year. And they said, what if we could basically get people to pay us ahead of the season? And so beforehand, the way that it worked was Vail's daily prices were down here and Vail's season ticket prices were way, way, way up here. But then they launched Epic. Epic in terms of the Epic season pass. And what they did is they brought the price of their season passes way down and the price of their day passes way up. And their goal was to say, hey, all that we need is to get this spread between the price of the day ticket and the price of our annual pass close enough that people say, maybe I'll ski 2 times. And if I ski 2 times, yeah, it's worth it to buy the season ticket. Because 2 really important things happen then. One, if they bought the season ticket, Vail got all that money before the season even started, totally de-risking their strategy. But the second and way more important thing is the power of the sunk cost fallacy. And the whole entire idea that everybody would look and be like, well, I paid for the season ticket. I should go ski more at the mountain because I've already got the season ticket. And if Vail has a whole lot of mountains, well, I should go to a bunch of different Vail mountains and I should only go to Vail mountains if I want to ski because I already paid for my Epic season pass. And that's incredibly powerful because what it does for the profitability of Vail or anybody who does a season ticket, anybody who does this kind of as a service solution to sell somebody continuous access if they just pay you up front. And what it does is it enables them to charge a whole lot more for the real profit centers of the business. When it comes to the ski lifts, you going to the ski mountain 1 time versus 5 times versus 10 times, there's no incremental cost for Vail in terms of building the mountain and maintaining the mountain. But what it does mean is you're going to spend a lot more at the bar, at the restaurant, at the ski shop. You're going to spend more taking lessons. All of these things, equipment rentals even, you're going to spend so much more money on all of those things, and each of those things stack up and give Vail more and more revenue. And that was especially true as Vail built out its whole entire portfolio of mountains. And the impact of this was staggering. Just for context, back in 2008, 25% of Vail's revenue came from season tickets. In the last 2 years, 64% of Vail's revenue came from Epic. Revenue per skier day climbed $30. And that might not sound a lot, but just do the math in terms of if you got a whole lot more skiers coming a whole lot more days, that $30 a day, it's a tremendous stack in terms of the profitability gain for the business. The numbers show up in the uniform accounting in a big way that the as reported metrics do not tell the whole story for.
So it's really interesting as people talk about McDonald's sometimes as being this master of working capital where customers pay for a Big Mac or they pay for food, and McDonald's doesn't pay for the ingredients of that food until weeks later, even a month later. Well, the king of doing this is really Vail. When they use that example of who's great at working capital management, they should be using Vail, and Vail has shown how it's gotten returns higher than McDonald's, even from 2% to 15% by 2018. The as reported, the GAAP accounting metrics, they don't reflect this stuff. They don't show just how good these things have gotten, right? And goodwill is one of the reasons, as well as things like not picking up things like how well working capital management is. It's in many ways, the Epic Pass was sort of a financial engineering wrapped in a consumer product when really it's just amazing. And when that return on assets went through the roof, so did the stock price.
As we come up to the summer season and everybody's thinking about what they're going to do in May, June, July, and August, and you're all thinking about whether or not you're going to make it to the theme park, the theme parks followed this playbook to a T also. Six Flags and Cedar Fair both jumped in whole hog into this. Six Flags, they came out of bankruptcy in 2009, 2010, and they basically said, how can we help solve the issues that we've got for our business? They said, well, look at what's happening for Vail over there. We also should massively cut the price of our season tickets. And if we do, we're going to get people buying more season tickets and coming through way more often. And we can see is it came through in spades in terms of the profitability for this business. Just like we've been talking about for all these other companies, for Six Flags, return on assets went from basically plus or minus zero to by 2018, it was 20% return on assets. And Cedar Fair also followed this business model to a T, and what it enabled it to do was for it to see its season ticket holders go from almost nothing for the business to now being more than 50% of the business was people who were in attendance from season tickets. That was what allowed it to be one of the most successful and stable experiential entertainment businesses of the last decade and a half. For Vail, it did something way more powerful for the business that enabled that return on asset rocket ship the company has had. What it did, Joel, to your point, was it gave the company cash. Because here's the thing, looking back at the late 2000s, early 2010s, even through the mid 2010s, all of the ski industry, other than Vail, was facing a real problem. They had old assets that they had to reinvest in. They were getting more unstable and intermittent snow, which means they needed to invest more in more snowmaking. And because of that, they just also had that same uncertainty that Vail had been facing in terms of all the volatility of not knowing whether or not they're going to have revenue there. So while Vail was raking in all this cash in building up its coffers, everybody else was scrambling for an exit. And that is exactly when Vail pounced. What did Vail do? Vail, over the next decade and a half, went on a acquisition spree. It acquired mountains that we talked about earlier, like Kirkwood and North Star in Lake Tahoe, Whistler Blackcomb outside of Vancouver, also Park City. When you look at how they got control of Park City, the mountain, the actual people who own Park City, they only owned the bottom half of the mountains, where all of the chairlifts started and the village. Everything that people skied on, all the good stuff, that was actually rented from somebody else. And Park City's owner forgot to renew the lease. And so Vail swooped in using its very, very big coffers, signed the lease, and then forced Park City to sell it to it at a distressed value. But it's not just that. They acquired Stowe and Okemo in Vermont. They acquired all those Australian mountains we talked about. They went on a spending spree. And the reason why was simple. More mountains meant more reason for people to buy their Epic Pass. But of course, there was a cost. To fund all that expansion, they got a lot of it from cash, but they also had to extend a lot of debt to be able to make those acquisitions. Remember how we showed you earlier that idea of how as reported return on assets really fell flat from 2015 to 2019 while uniform return on assets went up? Well, that's because they started spending a lot more on some of their acquisitions. They saw their debt grow 5x in the span of less than a decade. As a massive, massive ramp in leverage, because that's what they needed to do, they thought, to keep the flywheel going. But just as they were peaking, just as they were actually getting to the point where they were really excited and really investing and taking on all this leverage, something important happened to the business, and it only shows up when we look at it from the uniform accounting.
So just as the stock market follows the uniform accounting numbers, not the GAAP accounting numbers, you can see it here. When it peaks in 2018 and then starts falling, we can't blame 2020 and COVID on the returns. The returns actually started falling by 2019 and then fell into 2020 and then really haven't recovered since. And when you have a profitability that is that level of 2018 and investors get used to it and price a stock for it, and then suddenly you start delivering over 7 years, again, not just the COVID years, but 7 years of returns much lower, there's something wrong, and that's a stagnation, and that leads to problems in the shareholder return, in the stock price.
Exactly. And the stack of what happened here was really simple, everybody. One, saturation started to happen. There's only so many people who want to buy season tickets. In fact, in the last 2 to 3 years, the actual aggregate number of season tickets being bought, Epic passes being bought, has been declining. There was another thing too going on though. Remember what we talked about, how Vail its eyes got so big, it couldn't stop acquiring mountains? Well, the other really important thing that happened was from 2018, 2019 until last year, they grew their investment in their ski mountains by 2/3. They put a bunch of money into buying incremental mountains and also reinvesting their mountains, while profits stayed flat. And when you invest that much more without seeing any profit growth, that immediately gets you upside down. And the last thing is, of course, they've started to have an issue that even with that season pass key, that trick that they have, when skiing gets more uncertain because we have shorter and shorter seasons, more and more people have been asking the question, hence the plateauing that we've seen in ski passes and Epic passes season tickets. People are saying, do I really need to have that? And all that has stacked on top at the worst possible moment, just as Vail was massively ramping all of its debt to continue to grow the business. Okay, you might be wondering, understandably, why have we not mentioned Disney yet? The reason why, because it's a fair question, is Disney is a totally different business model on how they think about their theme park business relative to how Vail, Six Flags, Cedar Point do. And the reason why is because their strategy is actually not about season tickets at all. In fact, it's wild. When you actually go back a couple decades, Disney season ticket prices were very, very close to their day passes. They actually were facilitating the exact model that Vail and all the rest of them are trying to mirror now. But what Disney realized was that was not the smart thing for them to do. Because for them, right, the way that they make money is not the way, as we talked about before, how Vail, Six Flags, and Cedar Point do, where it's all about the money that you spend in terms of the experience while you're inside that, if you will, the four fences of the park or on the mountain and just below the mountain, right? Because when you think about Disney, their goal is that person who's coming with their family for potentially what might be a once in a lifetime, or at least once in the next 5 to 10 years experience, where they are ready to drop thousands of dollars for that one trip of 1 week, or maybe even 4 days, thousands of dollars staying on Disney's campus at a hotel that Disney gets a big on, eating, even if they're not in the park, eating at downtown Disney. And so the last thing that Disney wants is to have a bunch of Disney adults coming through who are season ticket holders, who are taking over the whole park, who aren't going to stay at the hotel because they're in Tampa or Orlando. They aren't going to spend money at the restaurants at Disney Downtown or anything else because they literally can bring their food on campus, and they're not going to pay for those big experiences. But by overcrowding the park, they push everybody else away. At the end of the day, Disney is nostalgia. And what is nostalgia if not that once-in-a-lifetime journey to the park that gives your child all of those lasting memories? Season tickets ruin that. On the other hand, for Vail, the season ticket pulling you back every single year and several times a year is the lifeblood of their business. And that's why Vail is doing what it's doing today. What's really interesting is as all of this has caused the business to start to fade, the market seems to be asleep at the wheel. Because Joel, as we can see here with embedded expectations, this company is not priced for that to continue, right?
You can see in the white bars, the forecast. That's not our forecast. That's the market's embedded forecast. To get to the current valuation, you need to have returns hold, not continue to drop, but hold at the levels that they've achieved into perpetuity. That's the line. That's setting the line. If you believe that for whatever reason, they're going to go back to 2018 peaks, well, then the stock probably has some upside. But if you think that returns aren't going to hold at this peak and that you are going to continue to see the decline that we've already seen, and you continue that declining trend, then there could be further downside in the stock.
And it's not just the equity markets that may be asleep at the wheel here. It also looks like the debt markets may not be paying attention to something also, and that is the world of cash flows, right? What we live here to do at Altimetry is to better understand cash flows, because cash flows equal survival and cash flows equal valuations. If you can't grow cash flows, you can't have higher valuations. And also, if you can't grow cash flows, you can't actually handle the debt. And that is what's jumping out for us right here when we look at this company in terms of its ability to not just be able to invest more, but to be able to handle the debt that's coming due. And this is the one most important chart if you want to understand what is so worrying for Vail right now and in the future. It's what we call our credit cash flow prime chart. Joel, you want to take everybody through this chart?
The only way to look at understand the balance sheet and the credit of a company, right? You see these fancy ratios out there, whatever else. The only real way to do it is a uses of cash and sources of cash. And it is the information is available in the notes. The information is available in the debt markets to get to what a single company's uses and sources of cash are. And so what are the uses? We got to see, right? So first, are there any debt maturities? Meaning you've got debt due and you better pay it. Next, what's the interest expense for the year? You've got interest expense and you would better pay it. There's what we call rental maintenance. Companies may have leases that are almost like debt. And if you don't pay that lease, you lose the equipment, you lose whatever you're leasing. So that is a must pay, right? And then dividends. Dividends may not be a must pay, but let me tell you, if there's anything that puts a shock to the dividends, and that is a big number for Vail, they are putting a lot of cash, the use of cash, into dividends and paying investors. Investors do not like seeing a dividend get cut ever. So you want to see a lot of cushion between that number and their ability to pay it. R&D, they don't have much here, but that'd be something we'd also look at if they need R&D. Pension servicing costs, and then maintenance CapEx. So this is equipment that they've bought, right? Equipment, machinery, you name it, that requires some amount of replenishment every year, meaning things do depreciate in reality. So it's sort of like true economic depreciation, the amount the company has to maintain in CapEx to keep everything working, right? The blue line, there you have, the blue line is the source of cash. That's the operating cash flow. And already there's a problem. It says that the operating cash flow is not sufficient to cover all the obligations of the company for this year. The blue dot, however, though, says there's, $500 million of cash on the books or something. There's cash around, and you add that to the operating cash, and it says, all right, as long as they dip in to their cash on the books, they're going to be okay. But their operating cash flow is not sufficient to cover the maintenance of this organization, right, for all the uses of cash. Now, we roll forward a second year, and we see a full year of operating cash flow. That's why it's going up, right? And each year afterwards, and you can see what people call debt head walls. there's a gigantic debt head wall coming, right? And just 3 years out, which says there's a gigantic debt payment due, and another one the year afterwards, and another one 3 years later after that. And there is neither enough operating cash flow nor enough cash on the books, because they're going to have to burn through some of the cash on the books to maintain their dividends, to maintain their interest payments, to maintain the quality of the equipment at all these parks, right? I say parks, all these mountains. And so what you see is the blue dot gets chewed up, if you will. There isn't anything left. You have that blue line. That's the source of cash just from operations. And you get these giant stacked bars. This company is going to see balance sheet issues. And what Rob was saying is that it seems like even the creditors may not be seeing this, because the fact is, if a company has real debt issues, how much is the equity worth? Equity is the last to get paid. Debt service comes first. This is saying they won't have enough operating cash flow for that debt service. They're going to have to do some real, I'll say again, financial reengineering to clean up the balance sheet, to push this debt out, probably at higher interest rates than they're paying now, right? Which means their interest expense is going to go up. But even if you knock out that debt service, you still have an issue where operating cash flow is just barely enough to cover their obligations, and maybe still less.
And if you look at it, right, this is the thing for this company. Best case scenario, you might have to have some real conversations about this company's dividend for the equity holders. But worst case scenario, this company's debt is trading at par. That means this company's debt is trading like it is 100% money good. It is going to get repaid. But when you look at those debt head walls that Joel was talking about in 2029, $1 billion, 2030, $500 million, there are some tough issues, because timing is what it is all about when it comes to debt. Because unlike equity holders, right? Equity holders love to do this idea of, well, what's the normal earnings this company can have? I'm going to slap a 20 times the multiple on it and I can value it. Creditors care about, I've got money due to me today. Do you got the money or do you not have the money? And you have a situation here where this debt is coming due, and this company's declining return on assets that we talked about, that's causing it to have lower and lower profitability every year, that it is going to have to make tough decisions. This is no longer a growth story. This is a survival story and a cash liquidity story. And so look, what does this all mean? Well, from a skier's perspective, it means enjoy it while it lasts. Because it's not just the snow that's getting worse season to season. The Vail experience is going to get worse season to season, because if they're not selling mountains or closing mountains, they're going to be underinvesting in those mountains over the next couple of years. From an equity and credit investor's perspective, though, it means something way scarier. That 20% drop we saw in Vail the last 6 months, we could see a lot bigger drops as this company's talking about dividend cuts, debt restructuring, and everything else. And for debt holders, it's going to be a big curveball too. Here's the thing is, if you're looking for the opposite of that model, look at Walt Disney, DIS, as we talked about earlier. They are raising prices, but they reinvest that back in the experience. And it's not just the park experience. It's about their entire ecosystem, from movies to streaming to franchising and parks. New rides, better parks, better experiences, more capacity. So customers keep coming back to the parks and to all of their media, and they're willing to pay more for it over time. Vail is extracting value. Disney is compounding it, and the market isn't fully sniffing that out yet. And over time, that's the difference that shows up in the stock, and why Disney is the stock to keep your eye on.
If you like this kind of deep dive analysis on stocks, where you get into and show data that Wall Street and the top of Wall Street's using, but you often don't see in mainstream financial media, then tune in for the Altimetry Authority. Like, comment, and subscribe. And in the comments, tell us what companies you'd like to have us look at in the future.